that the biggest reason why you are losing money in your account right now is because of the stop loss.
What?
Yes.
Bro, what are you talking about, man?
The stop loss is damaging your account instead of doing any good. And why is that? Well, that's exactly what you will learn in this video. And I will show you what to do with your stop loss to increase your win rate. And this also applies to your take profit, even though the take profit doesn't directly lead to you losing money right away, but it also decreases your win rate and destroys your account.
1 minute to go. It's a sell, it's a sell, it's a sell. Kablowy. Kablowy.
Now, I assume that you know what a stop loss is, and if not, let me explain in a minute. A stop loss is an order that closes your trades automatically with a loss if things doesn't go as planned. This happens even if you are watching the market or not. And on the other side, the take profit is an order that closes your trades in profit even if you are not looking. Now, I want you to remember that these orders are placed so that they will work even if you are not on the charts, right? Now, at first, this sounds great because you know that even if you are not there, your account will be protected from blowing. But there's a problem with that. And what is the problem? You see, the problem is that the market makers knows about the stop losses, and they use these stop losses to create liquidity and volatility. This is what is called a stop hand, and some people call it liquidity grab. Now, here is how the stop hands happens. You see, most of the time what happens is we look into the market, right? And we are going to see maybe the market pushing up, reaching a certain level, dropping, pushing up again, reaching a certain level, and then pushing at the third time on this zone right here. So this is a strong sell zone. We all know that we have to sell at this zone. So all the retail traders, so we know that this market is been ranging, so all the retail traders will be looking to sell at this point. Now, there's no problem with selling at this point. If I was looking into this market myself, I would sell at this point too. Now, here's the problem that most people do. Now, let's say you sell right here, you place your sell trade right here, you put your take profit maybe at this point right here, or maybe down this point, right? The problem is with the stop loss. What we do, most of the people are going to put their stop loss very close to this zone like this, right? And this comes maybe because of the trend of people talking about sniper entries and all the things like that. Well, you see, if you are selling here, there's going to be, you need to have buyers so that your sell order is going to be triggered. So for you as a retail trader, to place a trade here is just take one click and it happens in a millisecond. It doesn't take any time, right? But for institutional traders, they trade millions or billions of dollars. They can't just get into the market at this point at any time. What they need is, if they are looking to sell as well here, they need buying positions so that they can liquidate their sales. So where do they get their buy here to trigger or to liquidate their sell traders? Well, the thing is, when you sell, right? So for us, we sell right here. So where do we put our buy? Our buy is our stop loss. As I said, if you are selling, that means your stop loss is a buy stop, right? Which means if the market goes up and trigger that buy stop, right, it liquidates you and gets you out of that sell trade, and at the same time it triggers the buy trades of the market makers. Now, does the market maker or the broker choose you to follow your stop losses? No, there is hundreds or millions of people that have their stop losses at the same time. Why? Because as retail traders, we don't have much data. We rely on basic concepts like support and resistance, trend lines, indicators, moving averages. But for market makers, they have more data. They have level 2 data. They know the margin calls. Even if your broker is the market maker, they even know the amount of orders that are being placed at certain levels, right? Now, so what do they do? Before they get into this sell trade, they first need to get buy trades. So what they do is they push prices. They put in more buy trades right here, and then they push prices all the way up to liquidate all the stop losses that are here, which is called the stop hand. So what do they do? My point is, they push prices to the upside and then they hit your stop loss. Look what happened here. There's only one candle that went all the way up just to trigger all the stop losses that are here. And then after that, what happens next is that the market will likely push to the downside. Why? Because they have managed to liquidate all the trades that are here, and at the end of the day, your trades was right, your sell trade was correct, but you lost because of a tight stop loss. Now, the number 2 reason why this stop loss is destroying your account is a tight stop loss doesn't give you a chance to make money. It gives you a chance to keep losing money. You see, your emotions as a trader are triggered based on what happens. The more you lose, the more you fear. The more you win, the more you get greedy. That's exactly what happens to any trader. Now, if you keep putting these tight stop losses and you are losing, maybe after every 10 trades you lose like 8 trades out of every 10 trades, that means this is going to mess with you psychologically, and mentally you are going to be exhausted of these losing trades, and then you are going to lose. So what do you need to get good stop losses in the market? Well, there's 3 things that I want you to do. First thing is trade without a stop loss. Yes, this sounds like a bad idea. And if you are a swing trader and if you are in the market for a long period of time, this is a bad idea because the news can come, you can forget. If you are in Africa, the network can deal with you, and there's a lot of problems that can lead to you losing money or losing the entire account if you don't have a stop loss. But if you are someone who trades like for 1 hour, 2 hours, 30 minutes, like if you are a scalper and if you just trade on 1 minute or 2 minutes, 5 minute time frame, that means you have time to watch your trades. Just place your trades and watch it run. Now, when you do that, there's also other thing that you need to look for. You need to be strong mentally, because you need to know that, okay, I said I'm selling here. If the market go to this point, I don't care what happens, I'm getting out of the market. If I lose, I lose. But you see that most of the time you are going, if you, let's say you sell right here, you are going to give your trade some time to run, because psychologically you know that this trade have a chance to drop, so you don't automatically get out of the market. Now, this is not an advice for everyone, right? But if you are scalping and trading in a short period of time, it's good to not use a stop loss. Number 2 thing that you can do is use a wider stop loss and a smaller position size. You see, there's no difference, right? So what most people do is they will put a standard lot trade right here, right? And then they will put a stop loss right here and they take profit right here, right? The standard lot is like $10 per pip, right? But at the same time, what you don't understand is if you had used maybe a mini lot and then put your stop loss maybe right here, right? And your take profit maybe right here. This means that you are going to, number 1, be in a trade for a long period of time, which is what most people don't want to. But most importantly, this will buy you time for the trade to do whatever it wants to do before it pushes lower. You see, this move right here, from this point right here to this point right here, this looks like it's a long period of time and you don't have patience to wait all this time. But if we go to a higher time frame, let's go to a higher time frame and let's see how big is this move. Let's go to 4-hour time frame. You see, this can be covered in one trade. You see this? Now, the problem with putting a tight stop loss, as you can see here on the 4-hour time frame, is that your stop loss, even if we don't talk about market makers, stop hands and all those things, was just triggered with one trade. Why? Because the average price or the average size of this candle might be maybe 30 pips, and we are putting a stop loss of 5 pips on a 30 pip candle on a 4-hour time frame. So at the end of the day, you only need a week of a bigger time frame candle for you to be triggered out. So it looks a bit like a big move, but if you even go higher to like the daily time frame, you're going to see this is a very small move. As you can see, it takes one candle, which means instead of putting a bigger position size and a tighter stop loss, why not reduce the position size and put a wider stop loss so that you give yourself chances? Now, the number 3 way that you can use a stop loss to your advantage is using the ATR indicator. So let's get back to our example and let me show you what the ATR is. Now you can see this is our example. We want to place our sell trade here. So let's say we want to sell. We want to sell here and we want to put our stop loss, but we don't know where to put our stop loss. So what you want to do here to place your stop loss, you want to first know what the ATR of the higher time frame is. So if you are on the 5-minute time frame, I'm going to go to the 1-hour time frame, which is right here, and I'm going to look for the ATR. The ATR right now, the market is not moving very much, but the ATR right now is 0.126. Now we go back to the 5-minute time frame. Once you go back to the 5-minute time frame, I'm going to look for the ATR and I'm going to look for 0.126. 0.126 right here. So from here to here, this is the ATR for my 1-hour time frame. So at least I need my trade to be live for the next like 3 hours. So this is my stop loss. Now before I go to my take profit, I'm going to talk about why people lose because of the take profit. Now the same thing of the stop loss being very close to the entry is the same thing of the take profit being too far away from the entry. You see, the market doesn't move like with 100, 300, 600 pips, especially in Forex. In Forex, the market moves like on average 70 to 150 pips per day. So your take profit should be in that range. I see most people, they want to do something like this. They want to do something like this, and this comes because of what I talked about, the sniper entry trading trading advice. I don't know who came up with that advice, but this is destroying most of your trades, right? I'm gonna share with you this trade that I shared in my WhatsApp channel yesterday. I want you to see this trade. This trade was a winner, and we got into the market luckily at the best position. But even though we get this trade in a best position, look what is my risk to reward ratio is 2 to 1. Look how big my stop loss is. Look how close my take profit is. The take profit and the stop loss doesn't have to be too far away. I would recommend you to do 2 to 1 risk to reward ratio, even 1 to 5 to 1 risk to reward ratio. And this applies only if you have a averagely bigger account. By the way, if you want to join our WhatsApp channel, I will leave a link in the description below. But if you want your stop loss and your take profit to work very fine, you don't want to be your take profit to be so far away, use 2 to 1, 3 to 1. The only exception of using more than 2 to 1, 3 to 1 is when you are trading a very small account. When you are trading a $10 account, $5 account, you don't want to be, your stop loss is here and your take profit is too close, because at the end of the day, you are not going to grow fast. But if you are trading like a funded account, if you are trading like a big account that you need like 2%, 1%, 3% per month to make profit, you need these things to be close together so that you have almost a 50-50 chance of making money. Because think about it, for you to profit with a 2 to 1 risk to reward ratio, you need to win 30% of the time. So this is going to be my take profit. Now this trade is not guaranteed to win, but we already know what the market is going to do because I showed you this example earlier. But you can see that with this trade, I am very confident that even if the market start moving like this, and then even if it reaches my stop loss, well, I will take the loss, but then this loss is the same loss that I would have taken if I gotten out at the market here, because now I'm using a smaller lot size and a bigger take profit, and my trade have time to breathe, and also my stop loss is not too close to the entry. Now you can see this trade is going to take a lot of time, maybe it's gonna lose, but as you can see, the other advantage is that when the market maybe got to here, you could have maybe pushed your stop loss to break even. Now that you have like a 1-to-1 risk to reward ratio trade, you can see now that our trade have got much time to roam. We have all the time to manage our trade and see if we are going to make money or not. Now this, what we are learning here, only works when you have a bigger account or a prop firm account. Now if you have a small account like $5, $10, you need to watch this video appearing on the screen so that you can learn how to grow a small account from $3, $5, $10, or even $20. Do it now and I'll see you in the next video.